Hey there, everyone. Happy Monday. It's March 18th. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com in a sunny and beautiful, summery Redmond, Washington. Good to be back with you here in the studio. We're able to safely travel back from New York on Sunday. I had a great trip there, and thanks again to everyone that we were able to connect with in our time in New York. Good to be back here, though, in Redmond and reflecting on the charts today. Sort of a nice bounce higher, really, right, with communication services at the top of the list. It's not all good, though. SMCI, sort of one of those key stories in 2024, one of the biggest gainers, just accelerating to the upside, breaking below $1,000 a share, which is a pretty significant percentage drop from its all-time high here in the last couple of weeks. So we'll look at that rotation lower, but also look at some of the stocks really starting to take a new position of strength. You can look at material stocks with steel companies breaking out in the last week. Energy is an area we'll focus on today with crude oil above $80 a barrel. I think it's an interesting time to look at some of those energy charts you may have been ignoring. We'll look at how some of them have started to improve here in recent days and weeks. With that in mind, let's get to our market recap and look at how things played out through the course of the day today. Do want to start with a poll question we asked you recently on our social media outlets. Which ETF performs best over the next 3 months? And I think that's key to this question. Looking out 3 months mean, we're in mid-March. That means April, May, June. We're in mid-June, which, really the summer and an election year actually tends to usually be quite strong. But we've already had a lot more strength than probably would have been expected on the normal seasonal calendar. 44% of you said energy, which edged out technology. And I think this is really interesting, to be honest with you. After that, consumer staples, communication services at the bottom of the list. So, a real vote of confidence on energy, and seeing the results of this poll really inspired me to dig into some of the energy charts and think about what sort of opportunities we might want to find. The reality for the XLK for technology and for the XLC communication services, they've just already had such a run, right? So if you look at the relative performance of the technology sector, it's been quite strong, right? It's actually had a really nice trend over time, still in a primary uptrend, I would argue, with a pattern of higher highs and higher lows. The momentum is still strong. The relative strength has certainly been positive. But if you look at the trend in the relative strength over the last 8 weeks or so, it's not going up, right? Compare that to like the first 10 weeks of 2023, which is this nice, beautiful uptrend as technology is outperforming the S&P coming off of the October 22 low. Compare that to what we've seen really year to date in 2024. And after that first 2 weeks, the XOK has actually been, not breaking down a ton, but certainly not going up anymore. And this is the relative strength of the technology sector. Same can be said for some of those other sort of growthy sectors that have already had really good runs. The great thing for something like energy is it really hasn't had much of a run yet, right? On a relative basis, the relative strength has been quite negative, right? Save for sort of summer, early autumn of 2023. Other than that, it's been really rough since the fourth quarter of 2022. But if you look at the last month or so, all of a sudden this is starting to hook higher. So when I talk about leadership rotation, which I would argue we're very much in the midst of right here, I would say that some of those things you would look for would be energy and materials improving on a relative basis. We're seeing that. Technology, communication services probably rotating lower on a relative basis. We may be starting to see that as well. So interesting outlook period to think out 3 months. And for those of you that are thinking about energy, we'll look at some of those individual stocks here in a bit and see how they're looking right about now. Let's get to our dashboard and look at how things have played out through the course of today's trading. So the S&P gapped higher today, but through the course of the day actually trended lower. We actually closed just below 5150 on the S&P 500 to close around 5149 and change. Now that's up about 0.6% from Friday's close. So let's note that this is a net positive change, but the intraday sentiment really from around 10:30 Eastern, it was really more negative than positive. And the last 20 minutes was actually quite negative, sort of a steep sell-off going into the close. The Nasdaq Composite outperforming the S&P slightly, up 0.8% to just above 16,100. You can see mid caps and small caps were actually in the red today, and the small cap S&P 600 closed down 0.4%. So that whole concept of large over small, I would say, continues very much alive and well here in mid-March of 2024. The VIX remaining below 15, and that 15 level is an important one. We've had a couple of false signals where the VIX has spiked above 15 for like a day and then come right back down below that level. We saw that again last week. So the VIX, slightly lower, losing 8 basis points from Friday's close, but still remaining in the low 14 range. Looking at the interest rate environment, you can see the yield curve for the most part moved higher today. The 10-year point finished today around 434, slightly higher. The 5-year yield around 436, and the long bond yield just below 4.5. So we continue to see rates remain fairly elevated. Bond prices were down, with the TLT ETF down about 1/3% today, and the dollar index up slightly. We'll call it 1/4% from Friday's close. Commodities overall more positive than negative, although silver prices came down a bit, with the SLV down 0.5%, gold slightly higher, right around $200 a share for the GLD. We've talked about that long-term potential for something like gold. One of those shows last week that I did from New York talked about gold and Bitcoin in particular, and it's interesting how constructive some of those charts are. Gold has had a pretty impressive stretch here, and just again, coming off of new all-time highs here, pushing well above $2,100 an ounce. I would argue probably gold is an interesting place to be, particularly if you buy into this rotational mindset. Gold stocks have certainly been one of the underperforming parts of the market, and if you do get a pullback of more substance than we've seen so far in some of those growth leadership names, the Magnificent Seven, as we would probably want to call them, maybe gold is an alternative to that. Crude oil prices moving higher. The USO is up over 2% today. Looking at cryptocurrencies, a lot of red, and Bitcoin, which had been pushing above 70-some thousand, and 48 hours ago, we're up, or actually maybe 24 hours ago plus, we're up around 72,000. We're down about 5,000 points off of that short-term peak. So Bitcoin currently just above 67,000. That's down 1.8% from, on a Bitcoin, things like that trade 24 hours. Basically take a snapshot every 24 hours and consider that the beginning of the new day, although of course it's kind of misleading because it's a 24-hour trading, but currently Bitcoin in a bit of a downtrend. Ether prices as well, just below 3,500. Looking at the 11 S&P sectors, communications services number one, and it was not close. The XLC was up over 2% today. We'll look at that chart here in a few moments if I can remember to do so. The consumer discretionary sector and then consumer staples. So both consumer sectors were 2 and 3, both up about 0.6 to 0.8%. On the downside, just a couple sectors that were essentially flat from Friday's close. Real estate and healthcare were at the bottom of the list, and materials, which has actually had some really interesting charts out of the materials sector last week, up slightly today, along with industrials, both up about 0.2%. Now, we are going to talk a little later about what I call the Magnificent Seven and Friends. These are these 8 mega cap leadership names, so I don't want to talk too much about them, if only to tell you that Tesla and Alphabet had really good days here. Tesla was up 6.3%, Alphabet up 4.6%, and Meta up almost 3%. On the downside, all of these stocks were up, but you can see things like Amazon and Microsoft not having as nearly of a positive day. Now, what's interesting is Tesla has been by far the worst performer. This is a big bounce off of a relatively weak short-term level. Let's get to a daily chart of the S&P 500 and see how today's action sort of played out on the daily chart. And if you've loved this whole trend line analysis, we're still there. We just continue to what we call hug the trend lines. That's where you sort of draw a trend line and we just sort of revolve around that point. It happens a lot. When the more you use trend lines, you'll find this sort of thing happens. And again, trend lines for me are not a perfect science. It is really more of an art than anything. But for me, I found trend lines are a good visual way of identifying and really defining a trend, particularly the pace of the trend, and looking for what sort of signals, what sort of patterns would tell you that the trend is changing. We broke below that trend line on Thursday of last week. Friday session, we actually gapped, really didn't gap lower, but closed lower for sure. And so Friday, certainly felt like we were breaking below trend line support. Today, we actually traded right up to that trend line, but then closed at the lows, which actually gives today, I don't know if I would call it a perfect one. Yeah, kind of a shooting star type of candle. What's interesting is we basically traded up to around 51.70, 51.75. That's the peak. This is the last 5 days. This is Monday through Friday of last week. So Tuesday, Wednesday, Thursday, each day we topped out around 51.80. Today we actually traded back up to that swing high and it was repelled. Instead of closing to new highs, you saw sellers come in, and through the course of the day we actually pushed lower. So closing just below 51.50 today. So, as I've mentioned recently, I like to think of a line in the sand, and we get to a segment later called Compare and Contrast. We'll look at those 8 mega cap growth charts one by one and really think about that line in the sand. What's that level on each one of those that I would, if I were you, set an alert and just track as long as these stocks hold those levels, things just aren't getting that bad. But if you start to break those key levels of support, then you have to respect the fact that the trend may certainly have changed. For the S&P, I think that's right around 50-50. That's that swing high from early February. It's called the pivot point in my book because then it became support in late February and early March. That's that pink dash line that you see right here. So if we get chopped, which we've really been, it's been a choppy couple weeks here after making, a run up to 5,200. We break below 50-50. We get below that line in the sand. I would start to be a little more concerned than I am so far. I would say from a high level, the trend is still positive. My market trend model remained bullish on all time frames on the S&P 500. Not as much for some other indexes as I'll try to get to time permitting as well. Just two breadth indicators I wanted to check in on just to show you, and this was for my weekly flight plan for my Market Misbehavior Premium members over the weekend. We looked at these two charts. Just want to highlight that conversation. If you look at the bullish percent index on the S&P 500 today, moving slightly higher, we'll call it 71%. This next chart is the bullish percent index on the Nasdaq 100. You can see it's actually just above 50%. So the difference in these two lines with the bullish percent index on the S&P 500 still above 70%, still shaded red, still telling me we're in an uptrend until we break below that level. The Nasdaq's breadth really has not improved at all. As a matter of fact, it actually on Friday dipped just below 50%, meaning more than half of the Nasdaq 100 stocks were in a bearish point figure profile. You're starting to see more and more of those disagreement kind of conclusions where the S&P looks okay on one of these breadth indicators. The Nasdaq 100 very much does not. As far as my interpretation of that, I would say that plays into that theme of leadership rotation. You're seeing rotation away from the growthy stuff that has really been the story for quite some time in the equity space, certainly coming off of the October 23 low, which is right here on the Nasdaq Composite. But now you're seeing the Nasdaq Composite go higher on much weaker breadth conditions. The medium-term and long-term breadth on the S&P is still in great shape, but breadth based on the Nasdaq is actually getting a lot worse very, very quickly. And I think that shows you that discrepancy between the growthy leadership and the everything else leadership. And overall, it's telling you that latter group, the everything else space, is where I'd probably be shopping if I'm looking for particular ideas. I do want to point out the fact that the XLC did, in fact, make a new high today. We got 2% higher, and that actually took us above this recent swing high. I'm going to zoom in a little bit to the last year of trading so you can show what I can show you what I mean. So, right, coming off of the October low, we broke out above a very well-defined resistance level here, and then continued this pattern of higher highs and higher lows. It really continued until the beginning of February. From there, though, we see really a sideways pattern. The XLC has been flat on an absolute basis, really range bound between 78, we'll call it, on the lower end and 80 on the upper end. And when you have that sort of pattern, what I was taught is, all right, we're in a consolidation, we're in an equilibrium, meaning buyers and sellers are basically in agreement about how much this particular stock or ETF is worth. And at some point, either buyers take control and we break out to the upside, or sellers take control and we break out through the downside. You just wait, you're patient to see which way we break. And potentially today you're seeing that pattern break out to the upside, which actually would be kind of encouraging for the XLC. You really want follow through. So I think Tuesday would be interesting to see if you have follow through. I'm not sure if we're going to get it because we have Tuesday and Wednesday, which is the Fed meeting. Wednesday afternoon, 2 p.m. Eastern, we'll get the latest Fed announcement on any rate changes, not expected in my book, but certainly we'll update on the target rate. And then you have the Powell press conference around 2:30 p.m. I would expect a noisy one as investors really try to understand expectations for the number and the timing of Fed rate cuts through the course of 2024 and potentially beyond. So expect some dislocation in stocks and probably a quiet period Tuesday, Wednesday going into that announcement, and then probably quite a bit of noise. I didn't see a lot on the earnings calendar, by the way, until Thursday when you saw a decent number of things like Lululemon and Nike and others were on Thursday, but a pretty quiet week. I think the Fed is really going to be the story here for the first, certainly for the first couple days. A lot of questions about that, of course. Continuing on, let's talk about the energy sector, and I just want to show you, if the XLC looks like that, look how strong the energy sector has come off of those swing lows in January. And I'm going to do a one-year chart as well, just so we can kind of apples to apples the two of these. So communication services has kind of been range bound and then just breaking out. Look how energy really bounced off of a significant low, right? This was the low from December, really retested. It had this great hammer candle at the low in mid-January, and then we rotated higher, got back above both moving averages, which are now sloping upwards, and now we're overbought as we've continued to push to the upside. Now I'm going to take the dividend adjustments out just to show we're just slightly below that price resistance from September and October, but we're really within a rounding error, right? Friday's rally put us right up to that point. So I would certainly expect some, at least a bit of a pullback. We've seen that today here slightly. I would say overall, though, this is very much in a strong position when you look at the last month or two, coming off of that support level and then really pushing to the upside. The real story I would say here, though, to focus on is the relative strength. Now, ways you can think about relative strength, I mean, number one, look at the RRG, and you'll see how energy has started to improve a little bit. On the weekly RRG, it's way off on the left side, as I discussed with Julius de Kempener when he was last on the show. But also just look at the pure relative strength, just the relative performance of energy versus the S&P. I'm going to put the dividend adjustment back in so we're comparing these on an even basis. You can see what I'm talking about. The relative strength obviously down from October of last year, really through mid-January of this year. But then look how it's stabilized and just starting to turn higher a little bit. If that's the beginning of some further improvement, maybe it's time to get in a little early on that relative story off the lows for something like the XLE. Now, when you zoom into some of the stocks within this sector, you can see where the strength has come from. This is Diamondback Energy, ticker Fang, which is not the Fang stocks, of course, but an energy number. It's an E&P stock, meaning exploration and production. You had this gap higher the second week in February, and then just look how it essentially continued higher pretty much consistently. You had a brief pullback there in February, but overall, it's been a nice move higher. So clearly there's demand to own these the stocks like this at a higher and higher level. MPC is Marathon Petroleum. This is one of the integrateds. The two big integrateds which dominate the others are ExxonMobil and Chevron. But then you get into a bunch of other ones that are sort of still in that large cap space, but not as huge. So Marathon Petroleum market cap just below 70 billion, but you see this nice consolidation here. September, October, November, December, January, then February, you finally break out. And this is when I talk about big base breakouts. MPC might be one of those examples I use in future presentations because that move right there, I think, tells you something. And the fact that you then continue to see demand above there is what's really encouraging as well. DVN, Devon Energy, is another one we like to talk about, getting back above the 200-day moving average, just breaking above this resistance from early January. So I'd certainly like to see if that's able to hold, and certainly if we could hold the 200-day moving average. That actually served as resistance for 6 months prior. We'd consistently failed to get above there. This is something different potentially. Then, of course, you have pipelines, things like OKE, whose name I will not attempt to butcher at this time, but a number of other pipeline companies, names you may not be familiar with, but tend to have a very high yield. This one's a 5% yielder. And when they're going up in absolute terms, then you have sort of the double benefit of strong capital appreciation, meaning the price is going up, and strong income component, meaning it pays a decent dividend. And that's what you're seeing here. Even with the rally in OKE, still paying a pretty healthy dividend as well. Just to finish off our market recap, I do want to highlight that SMCI, it actually closed almost exactly at $1,000 a share. I got the ding on my cell phone earlier when it got down to around $9.50. Now, we did pull back. Now, before you say, well, hold on, $1,000 a share, this is pretty decent. It was at $1,200 about a week ago, meaning this is a 20% haircut from that high to that low. This is how these big accelerating companies, these euphorically driven, parabolic risers like SMCI, Bitcoin at times, brief pullbacks on the chart don't look like much, but these are big busting of the percentages here. That's a 20% loss there in about a week or so. So keep an eye on this one. I would probably be getting more defensive or certainly thinking about ways to think about and manage downside risk on a name like this. Already down aggressively, but certainly plenty of daylight below current levels to get to some of these previous swing lows. 800, which is that last swing low, is another 20% below today's close. So keep an eye on that chart if you've not done so yet. That's our market recap. Again, touching on some of those key rotational elements, I would say is best way I would describe it. Certainly a theme we've addressed, which we'll continue to talk about this week. A couple quick announcements before we get to our next segment called Compare and Contrast. First off, we'd love to hear from you. Appreciate so much all of your feedback. A number of you responded to our survey earlier this year. Really taken a lot of your feedback to heart. We're in the process of evolving Stockcharts TV thinking about what content we provide to you, how we do it through the course of a normal week. More to come on that. But would invite your questions as always. We'll keep doing the mailbag. It's been a lot of fun with some thoughtful questions from all of you. So please take a moment, think about what questions you're running into in this market environment using technical analysis. Email is always best, thefinalbar@stockcharts.com. On X, just tag us in a comment @finalbarsctv. And on YouTube, just hit us in a comment below the video you're watching. Stockcharts TV is our YouTube channel. Also want to let you know I have a webcast coming up tomorrow on Tuesday, March 19th, 1 p.m. Eastern, called The Market Top Checklist. I'm going to have to look back and see when I've scheduled these because I think this is the third webcast I've done along the lines of this theme. And I usually do it when at least one of those items has been checked off, which it was actually in recent week, the first one which involved divergences. Join me for this free event. You can sign up for it at marketmisbehavior.com/checklist. I'll walk you through the 7 steps. That first one that I've checked off and the other 6 that I'll be looking for, you can have the checklist in a PDF format. It should be a lot of fun, and we'll think about what information we would need to see, what evidence we would need to gather to declare a market top. I don't think we're there yet, but certainly I'm in the evidence gathering mode. So sign up for that event coming up tomorrow, March 19th. Our next segment is called Compare and Contrast. Having so much fun going through some of our old segments and revisiting them. This is a segment we used to do quite a long time ago. And it was a way to really just think about comparative analysis. And comparative analysis for me, I think, is super valuable. What that actually refers to is, analyzing one particular chart is usually not the game. I would say as an investor who invests in individual stocks, or if you're a swing trader or even an analyst that covers individual names, it's not just about one chart and what the conclusion is. That's a lot of times the easy part. It's really more thinking about how this one chart compares to all the other ones that we may be able to buy or sell at any given moment. And whether you're looking at the right chart or not is probably the most important question to watch. So what I wanted to do was look at this group of stocks, which I call Magnificent Seven and Friends. We could debate which stock should be in this mega cap leadership group of individual names. But these are the 8 that I think are most important. And I've also included the Fang Plus Index, which is probably as close as I would come up with an index that tracks this particular set of stocks. Now, you could argue the QQQ is probably decent as well, and these names are such a big weight in the QQQ, it's honestly very, very similar. But this is really as close to a direct kind of Fang universe as I would probably want to bring up. Now, the first thing we're going to do is sort these in terms of their scooter ranking. And this is anytime you have a list of names and you want to sort of start off and say, all right, let me understand these names and what they mean, how they relate to one another. The scooter ranking is a really good place to start. I don't think it's the end of it. I don't think that's the end of the discussion, but it certainly makes sense at the beginning of your analysis, just to start to see what's working and what's not based on that proprietary combination of tools that we bake into our Stockcharts technical ranking or scooter ranking. Now, you can see that 3 of these 8 stocks are within the top decile, right? The top 10%. This is a percentile ranking from 0.1, 0.1, I think it is. This is the lowest number, and it gets all the way to 99.9. I believe that's the way we have this laid out. You can see Nvidia actually within the top 1% of large cap stocks. Meta and Netflix both in the top 5% of large cap names. So when you look at those names and rank them top to bottom, these are your strongest charts, right? These are the names that arguably, even though a lot of individual stocks have struggled a little bit as of late, and a lot of names like SMCI are off quite a bit on percentage terms off of their recent all-time highs, these charts overall remain quite strong. Then you have this next bucket where the rankings are sort of middle ground, right? You have Amazon and Microsoft in the 70s. You have Alphabet down here in the 50s. And when you get to Alphabet and below, this is that third bucket of stocks, which I would argue definitely not great. At best, they're good or maybe okay, but at worst, you have something like Tesla with a nice bounce today, 6+% off the lows. But overall, out of an entire large cap universe, this is literally in the bottom 1% of stocks, or bottom 2% really, with that particular rating. Apple's in the teens. Another thing you can do if you're trying to make sense of this group and what they've done is use the performance table, right? And this is something that we have in our main portion of the website. In ACP, there's a table you can bring up below your chart where you can actually do this performance analysis as well. So I'd encourage you to explore that. Just bring up that little panel below your chart in ACP. But when you bring up the performance table, I would sort by year-to-date performance, sort by whatever measure you want to do, and you'll see it lines up pretty well with the scooter rankings, and that's because performance and certainly trend is essentially the game. That's the biggest part of what those scooter rankings are trying to understand, is just a relative ranking of all of these trends. You can see Nvidia, as of today's close, up about 79% year to date. Meta Platforms is up 41%. Netflix up 27%. Then you can see pretty big gap, obviously, from Nvidia to Meta, and then Meta to Netflix. Then we get down to a group of stocks in their teens. This is the Fang Plus, so ignore that one. So Microsoft there. Alphabet is up in single digits, and then you have two of the Magnificent Seven that are actually down on absolute terms. Apple down 10%, and Tesla, again, by any definition, at the bottom of the list, down about 30% on the S&Ps. Probably up 8% year to date, I would say, would be my guess at this point. Now let's look at these charts one by one and just think about how each of these charts individually, what sort of levels are you paying attention to? And what I would encourage you to do is take a list of stocks, and whether this is the Magnificent Seven or some other list that's important to you, a watch list or your portfolio or whatever, go through this exercise, right? Look at the scooter rankings and think about what's working and what's not. Look at the performance over time. Think about what's working or not. Then do this part, which is go through each of the charts individually. And I would encourage you to find that line. What's that line you can draw on the chart, which I call the line in the sand? What's that level that tells you something's different? And if things are going down, you probably want to draw a line above there because you already know it's going down. So like in a downtrend, I'd be drawing lines here. Like, what would we need to do for me to turn bullish on Meta? Okay, we break above a swing high. That's good. This was a level that I drew back here in November, December, coming off of the low. It's like, all right, if Meta can get out of this range and break above here, I think this could be pretty encouraging, and certainly it has been. Now that Meta is in an established uptrend, and again, the order is generally from strongest to weakness, but not exactly so. I would draw this line here at the top of this price gap. A lot of these names have a gap in January, February. That was that first quarter earnings that came out. A lot of these had nice positive surprises, and I would say that was one of the big catalysts in the first quarter, with these names dominating returns so far year to date. But Meta gapped up to around 450, sat there for about a week or two before continuing that uptrend. Now, in the last week or two, it's actually pulled back from an all-time high around 525, but we're still around 500, right? So not too far off of that level. The 50-day moving average and my line in the sand are both right around 450, and that's probably where I'd be setting an alert. As long as Meta holds that on any sort of pullback, this is still a pretty good chart on the time frames I'm thinking about, which are sort of medium-term, long-term, like a month or two and further. We start breaking that level, though. We break below the 50-day moving average for the first time since, really the October low of last year. Then I think it's cause to be concerned, but not yet. Nvidia is this chart right here. You can see the February peak was around 70.50. We pulled back, and I remember vividly these 2 days where I was like, all right, Nvidia might be tanking. Like that might have been the top. Uh-oh, things are getting bad. All of a sudden, we gapped higher, closed at the highs of the day, and then pushed on. Almost got to 1,000 a share, but did not quite do so. And we had that bearish engulfing pattern, which we highlighted on our YouTube channel. And then for the last week, it's been sort of choppy sideways. So, there's a lot of volatility in names like Nvidia, like SMCI, these stocks that have had these vertical runs. But, now it's a question of when we pull back, do we hold support? I might have a short-term kind of a tactical level around 850, but I think the real level's here at 750. Now that's, 20% off of all-time highs. That's a pretty big drop just to get to that level. And I think that's, again, the nature of how much these names have run so far. So I'd probably set an alert around 850 just to see if it can hold that swing low. But then the real line in the sand for me would be probably 750. Amazon is our third one, kind of a similar chart to Nvidia in that you have that swing low, that gap level. Meta as well, right? Then again, I think as long as you hold that gap on a pullback, I think things are okay. The 50-day moving average also lining up right around 166. Now, this is probably one of the better examples of bearish divergences that I think we've found in a lot of places in the growth space, right? So bearish divergence is basically when you trend higher in price, you're making higher highs, but the momentum is sloping downward. So higher highs February into early March, lower highs in momentum, overbought here, not overbought there. That usually is a sign of market exhaustion, and I'm wondering if that's going to be the case here. Now, you really haven't given up too much ground from that swing high around 180. For me, 165 would be the swing low after that gap. It would also be the 50-day moving average. So you see a number of these names, these first 3 or 4 names, it's all kind of that same point. Microsoft looks a little different and is certainly one of the stronger performers in this space, But again, a really clearly defined support level. The 50 days above here a little bit, just around 403. You can see the support levels around 397, we'll call it. But I think holding that would be key. Just like Meta, you can see, or Amazon, that is, you can see a clear bearish divergence here with a new high last week. That was on Thursday, and much weaker momentum. We didn't even get up to an RSI of 70. So again, some of these names that have held up quite well, they're doing it on weaker momentum, which is usually not a great sign. Netflix, I've had people write sometimes with a little bit of angst that I'm including Netflix as one of the Magnificent Seven. I mean, you can debate it all day. I think there's reasons why and why not. On a market cap basis, it's much smaller than some of the other names, but streaming is pretty key right about now, and I think it's a decent way of just seeing how a company like this, which is really more of an established player in streaming media, is it able to continue to grow? I think that's an argument. I think there's an argument to be made, just that fundamental thesis of that as an investing topic. And again, recent pullback in February to right around, we'll call it 550. The 50-day moving average is slightly above there. So, again, you can see the room that a lot of these names have. That's about 50 points. It's about, 8% off of current levels, just to test that first support level. Couple more left here, then we'll wrap the show. Alphabet and the next two, Apple and Tesla, are very much outliers. The first 5 charts quite strong, right? Very strong to kind of strong. These ones not so much. Now, Alphabet, I do want to highlight what's called a shooting star candle. It's where we gapped higher actually today. We traded up to really retest the January high just above 150, but we closed back at the lows of the day. That is a short-term distribution candle. So the fact that we were up almost 5% seems very bullish. The way today played out, and the fact that we closed at the lows, for me, does not read like a very bullish chart. So I think further decline tomorrow might invalidate that gap higher today. Apple, by the way, did open higher, but again, closed at the lows of the day. So some of these weaker names, Tesla actually did just fine into the close, but some of these other names actually started earlier in the day, looked like they were really starting to improve, but sellers came in and really banged these things up going into to the close. So it's still within that range. That line in the sand for Apple for me is around 169, 170. That's that swing low, and also a Fibonacci level, which we highlighted on our YouTube channel. Finally, Tesla had broken below Fibonacci support today, sort of trading up here, and I'm wondering if this is a breakdown and then the retest before the real decline. Now, Tesla was pushing higher on a series of tweets and maybe other things, but certainly be talking about the Roadster, what that might look like, and some other things. But overall, again, a chart is like this, I would say, is guilty until proven innocent. I haven't seen enough to say this is an obvious winner. I think getting above some of these recent congestion areas, actually putting in a higher low, that would be something to get excited about for something like Tesla. I don't think we're there yet. So that's our segment, Compare and Contrast. So it's really focused on what we call the Magnificent Seven stocks. But I hope that you can take this as sort of a tutorial on how to take a list of stocks and really think about, compare and contrast those technical patterns, use things like the performance table, the scooter rankings, and also the chart list to really go through them one by one and think about what levels, what patterns are going to help you understand any change in trend. We got to wrap the show, folks, and go to the 3 and 3, 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. I mentioned the strength that we're seeing. Oops, actually, that's the third one. Let me start at the top one. Looking at the market trend model. The S&P 500 market trend model is the main market trend model that I track. I report on this every weekend for my premium members at Market Misbehavior, and there's a new dashboard widget, if you haven't set it up, that actually shows these this market trend model on 8 different things, really 7 different items, color-coded arrows that show you where they're at. But this is the chart that I used to design this model years ago. And long-term, medium-term, short-term on the S&P still bullish. The Nasdaq 100s as of last Friday, and it might have been the Friday before, no, actually it was just last Friday, actually went negative. So the Nasdaq 100 did turn short-term bearish for the first time since really October, November of last year. The S&P is still hanging in there, and again, I'm seeing more and more things showing me that the S&P is looking one way and the Nasdaq is looking at another way, and that's because the S&P has the benefit of all these other sectors where things are actually starting to do a little bit better, and so that's allowing the S&P to look a lot better than the Nasdaq as an index in the short term. In the long term, medium term, still very homogeneous, I would argue, between the two. Now, the trend in the Fang stocks has been quite strong, and this is the New York Fang Plus Index as of today's close. It might have been actually before today's close, up about 13% year to date. The S&P and the Nasdaq 100 up around 7 to 8%. The S&P up about 8.5%. So the S&P has been outperforming the Nasdaq 100 year to date, and that really started to they separated each other so far through the course of the month of March. But on this chart in particular, I want you to look at the trend in these data series, right? The New York Fang Plus Index, I would argue, while it's had some upswings, is kind of trending downwards over the last month or so. The Nasdaq, which is here in red, kind of trending downwards. The S&P kind of trending upwards, and that kind of difference between the trends in the S&P and more growth-oriented indexes, I think, is becoming more and more magnified here as we go through the month of March. I think that, again, might just be the beginning of further differentiation between those parts of the market, with value maybe outperforming growth for a while. With that in mind, which names are working? This is a material stock, Steel Dynamics, $22 billion name. STLD is the ticker. This is the weekly chart going back for the last 7 years, just to show you, making new all-time highs here in the last week. But that's really getting above a significant resistance level from the beginning of 2023, first quarter. Look at how this is rotated. I gave up a lot of ground in the first half of 23, really had this rounded bottoming pattern, then really starting to improve. When I look at sectors like industrials, materials, financials, maybe even some healthcare, I'm finding charts like this that are really starting to work. So if you want to identify areas of opportunity, look for stocks that have really started to improve. Scan and look for names that are in a positive trend after not being in a positive trend, and that's where you could find the next Steel Dynamics. Folks, that's a wrap for the show. Thanks so much for joining us every weekday after the close for the final bar, and I'll see you on tomorrow's show for Stock Charts here in Redmond, Washington. I'm Dave Keller. Be well, stay safe, have a good night.